Hello. So the company we are talking about today is Network People Services Technologies Limited. Okay, that was a mouthful. This is around 3,200 crore market cap company, 79 times price to earnings ratio. And what does it do? It provides software products and technological services in the fintech sector. Now, why are we discussing it? If you go to the P&L of this company, okay, P&L of this company, you can see 195 crores of revenue in fiscal year 2026, 51 crores of operating profit or EBITDA fiscal year 26, and 41 crores of net profit. If you take a look at the revenue growth, 12.5% fiscal year 26, 35.8% fiscal year 25, after an explosive 212% revenue growth in fiscal year 2024, 100% fiscal year 23. So, last two fiscal years, the growth has been, revenue growth has been below 40%. Moreover, take a look at the operating profit margins, slipped to 26%. Profit after tax fell in fiscal year 26. So, why are we talking about this company? Now, the company's plans are actually pretty interesting. For fiscal year 27, they're targeting around 70% revenue growth, 340 to 350 crores in revenue. Moreover, by fiscal year 2029, the company is targeting around 850 to 900 crores in revenue, 70% CAGR. It's not really 70% CAGR. It's more like 60 something percent CAGR, but really high. Okay. It's a pretty high growth on an absolute basis. So yeah, the company is targeting around 850 to 900 crores revenue as a baseline range for fiscal year 29 revenue. Moreover, in fiscal year 2027 alone, 340 to 350 crores in revenue and a return of operating margin to fiscal year 2025. So around 33 to 35% operating profit margin. Moreover, on that fiscal year 2029 stuff, the company, or around fiscal year 29, perhaps it could be fiscal year 2030 also, the company is expecting around how much operating profit margin? Close to 40 to 50%. 40 to 50% is the EBITDA range or the operating profit margin range which they're expecting. So not only is the company expecting high growth rate in revenue, they're expecting an expansion, a big expansion in EBITDA margins. And as far as I know, the company is not debt heavy. Okay, it is not debt heavy. It is not even a lot of dips or fixed asset heavy. So interest costs and depreciation are actually not that much. Now, a bit more clarity on the company. So we're talking about basically three segments. Okay. Technology service provider. You can pause and read. Okay. Technology service provider, a payment software partner for banks and fintechs. Okay. Payments platform as a service. It enables banks and fintechs to launch and manage their own payment services end to end. Okay. Banks and fintech platforms get their own payments platform as a service. Then we have regulation tech. I guess that makes pretty much sense. So these are the three segments of the company. Okay. This is how the revenue gets divided. Now, hold up. Yes. This is more or less the plan. So first of all, expected business growth next 3 years, 70% CAGR. We saw it. It could be 70% CAGR. According to the con call, what management said in the con call, it was not really 70%, close to, approx for fiscal year 27, they're targeting that. Now take a look at this chart. This chart, okay? Business contribution as per margin. Now this stuff, this at the below margin, low, high, medium, high, very high. It may not be that visible, but please bear with me. Sorry about that. So fiscal year 27. Okay. You see this big one, this kind of, I don't know what this color is. This is the low margin. And you can see the very green one, the darker green one, very high margin. So fiscal year 27, they're expecting this. Now, as we move forward, you can see the darker green margin is increasing. So very high margin is increasing. Then the high margin, this lighter green shade, is also increasing a lot from fiscal year 27 to fiscal year 29. And the low and medium margin stuff, you can see low. Low is going down a lot, even medium margin is increasing. So basically, it's saying that revenue to grow along a lot, to grow a lot till fiscal year 29. That is the plan. And the higher margin revenue to come in. More percentage to coming from higher margin revenue. And what is this higher margin revenue? Let's get a bit of estimation here. So this kind of summarizes it very well. You can see technology service provider, payments platform, RegTech, all three segments. Now, first, let's pay attention to one thing: international, international, international. In all three segments, take a look at international. See, fiscal year revenue contribution. Nothing from international in TSP, nothing from payments platform, nothing from RegTech, nothing, nothing from international. Then fiscal year 27 from TSP, 10 to 15% revenue of the TSP, I guess, coming from what? International. Then I think, yeah. Then fiscal year 29, 25 to 30% of revenues to come from the international. Okay, international. And take a look at the margin. The margin in international is more. That is very important to remember. The international business, which they now expect and they're aiming for, they're working and the aim is to make the international business way bigger from basically scratch. Right, the revenue contribution seems to be almost nothing from the international higher margin business. They're trying to make it big. 25-30% from TSP, 10 to 15% in fiscal year 29 from payments platform international. Regulation tech 5 to 10%. And you can see in regulation tech, it's very high margin. Look at this, very high margin. International payments platform segment, very high margin, 5 to 8%, 10 to 8, 10%, 10 to 15%. In TSP also, you can see high margin, not very high, but high margin international. So you can see it increasing. So basically, the company is expecting growth to basically come back to the explosive kind of range. I think 70% could be said to be pretty explosive. Margins to recover, and even on the PAT side, even if you focus here, let me come back. Yes, you focus on the interest expense, you focus on depreciation. You can see it has risen, of course, but look, compare it to the EBITDA, compare it to the revenues, and compare it to even the other income. That is the income you can get from fixed deposit, interest, or whatever. But other income could be one off, could be recurring. So I guess, of course, the recurring should be focused on. But if you see that, as of now, the company has not shown to be even depreciation heavy or even like debt heavy. So let us see how this company, it's a mouthful of a name, Network People Services Technologies Limited, will do in the future. The company is aiming for, of course, high revenue growth. That's the aim, only the aim. This is not a recommendation or anything. Okay, the aim is high revenue growth and big margin expansion, as they're focusing way more on international revenues, which are supposed to be a way higher profit margin.